Hi, it's Joni Michaels, and it's my pleasure to introduce you to Joe Clark, host of Consider This Program. Joe's a certified financial planner and former professor at Purdue University. He's the managing partner for the Financial Enhancement Group. Joe's passion is teaching people about their money so they don't make inefficient financial decisions that lead to frustration and devastation. The Financial Enhancement Group serves more than 900 families in 31 states and manages more than $400 million. The Financial Enhancement Group takes care of people who don't want to worry about their money so they don't make inefficient financial decisions. Joe addresses your questions about money in 5 critical elements of finance: retirement planning, or what we like to call your life after work, tax planning, investment planning, life happens, the good, the bad, and the ugly of life, and legacy planning. The Financial Enhancement Group can be reached at 800-928-4001 or visit yourlifeafterwork.com. The Financial Enhancement Group is an SEC-registered investment advisor. Securities offered through World Equity Group, Inc., member FINRA, SIPC.
Well, good morning and welcome to Consider This. I'm your host, Joe Clark.
I'm Ken Dilger.
And I'm Angie Kinzer.
Happy New Year to everyone. I cannot believe we're in the middle of January, but we are. So we're going to start off with something fun that Miss Angie Kinzer found.
Yeah, I found something called 10 Things Most of Us Can't Live Without Today, but our grandmas did.
Ah.
So
we'll see if Dilger can make it without some of these things. I don't know about his grandma. Go ahead.
Okay, number 1.
Okay.
The internet.
Could you live without the internet?
I would say no.
That would be a tough one for me.
Would it be?
Yes.
I love buying my books on my Kindle, but that's the only thing that I think I could survive.
You're not a Googler?
I Google to do research, but I also spent years of my life at Bracken Library in Muncie on the debate team learning how to do microfiche and get stuff out of magazines.
I don't miss that because half the time you look for stuff, it's
it was
ripped
stolen.
out of
Yes, it was gone.
Encyclopedia or gone.
I
don't miss those days.
All right, the internet was one.
The internet was one. Passenger jet airliners. So those weren't out till 1958.
Really?
Really?
I guess they were all commercial.
That was the introduction of the Boeing 707.
You're right. I would be in trouble. I wouldn't make it without that.
Okay, then we got credit cards and debit cards.
I'd have never used a debit card in my life, nor will I. And I use credit cards for everything I possibly can.
Right.
Do you use a debit card, Ken?
I have one, but I haven't used it in a long time.
Ain't gonna happen.
Well, I never have cash. I'm used to having kids at home getting in there for lunch money and everything else. So my debit card's okay. So then we got automatic banking services, personal computers. This is one. Okay. Could you live without your cell phone?
I almost did. Barb and I went on vacation, and I left my phone in the car. Barb messed with my process. And we got to the Cowboys game, and these tickets are so sophisticated off of something called SeatGeek that I couldn't even get my ticket, so Kendra flew the phone down to me. It's like my own little UPS service in the middle of the day.
Oh, my gosh.
Other than that, I didn't touch it. You didn't see me, a text from me, a Facebook thingy from me for a whole week. It was done.
It'd be pretty tough, though.
It would be tough for work because you always have access to your work, your emails.
I'm good when I'm on vacation, but you're right. I certainly use it as much as anybody for work.
Well, how about payphones? When's the last time you saw one of those?
It's been a while. Yeah, that one we can live with. Yeah, we don't need that.
Okay, so overnight mail delivery.
Yeah.
Permanent press fabric, which didn't come out till the late 60s.
I don't even know what that is.
That means you don't have to iron anymore.
And I use it a lot.
Do you?
Be careful what you say here, because this could go really bad for you again.
I use fluff on the dryer more than I use an iron.
I will tell you one of Napoleon's battle strategies, which I think is genius, is he refused to answer the mail for 3 weeks, didn't even let his people open it up. Said 90% of the problems were solved by the time he got to the mail. Why should he worry about it every day? I do believe we spend way too much time making decisions way too quickly over things that really don't matter because they fly at us so fast that we think we are supposed to respond. Next week, by the way, just as a precursor, we will tear apart the Secure American Act so that you understand everything that you need to know for your IRAs and the rest of your investment world. We'll take a break. We'll be right back.
Hi, Joni Michaels here. We know you care about your money, but are you tired of worrying about it? The Financial Enhancement Group takes care of people just like you who don't want to worry about their money. As fiduciaries, the team at the Financial Enhancement Group will care for your nest egg just like they would care for their own if they were in your situation. There are many decisions you'll need to make as you face retirement, and the team at the Financial Enhancement Group is here to help you. Call 800-928-4001 or go to yourlifeafterwork.com to set up a time to meet. The confusion and complexity of retirement is almost as daunting as is the excitement of retirement. Don't let your fear and frustration of taxes and investing derail your retirement. Call the Financial Enhancement Group at 800-928-4001. They'll give you a complimentary second opinion on your strategy for retirement. Begin your adventure in your life after work. Call 800-928-4001 or yourlifeafterwork.com. Now back to Consider This program with Joe Clark.
So when you sell things, do you have to pay taxes? And the answer is, it depends if it's in an IRA, if it's in an annuity, or if it's something that you bought in what we would call a retail account, maybe even a house. Hi, I'm Joe Clark, host of Consider This.
I'm Ken Dilger.
And I'm Angie Kinzer.
Happy to have you along. Remember, Angie is all things Consider This program. So if you've got a question about how to get to our podcast, a better way sometimes to listen to the show in case you missed one of the conversations, you can call Angie at 800-928-4001. She's the one that can answer your questions, get you hooked up to the podcast. And if you want to come in and talk to somebody on the advisory team at the Financial Enhancement Group, she is your boss. Or your connection, I guess I should say. But now, how to figure out your cost basis. Go ahead, Angie.
Well, a question that came in was, does cost basis also apply to the sale of a home?
So what is cost basis?
It's what you paid for it,
Yeah.
right?
It's what you paid for it after tax. Always have to remember that other part, right? It's what you paid for it after taxes, because this is a really confusing question. People will come in sometimes with their IRA statements, and the brokerage firm doesn't notice that it's an IRA or doesn't care that it's an IRA, and will tell you your cost basis. You bought 100 shares of IBM at X, and people will say, well, that's my cost basis. Your IRA doesn't have a cost basis. If it's a tax-deferred IRA, it is at zero. You have a cost basis on stuff that you've bought where you've already paid taxes, which could very well be a house. But Ken, it's why when you help somebody buy a home, their primary home, you never to get to depreciate the house and the house that you live in or the house that I live in. But this building that we're standing in, clearly real estate, I depreciate it every year on my taxes, right? So my cost basis, that's what depreciation means, is actually going down, right? So cost basis is what you paid for something after tax. Very key word.
Well, can home improvements impact that?
Absolutely. They raise them. And it's why most of the time in the state of Indiana, it doesn't matter a lot. You have to have more than $500,000 of gain. And that's after all of the things you've put into the remodeling and, new roofs or whatever it is before you even have to do that, assuming you're married filing jointly. And we just don't have a lot of houses that have that much gain in Indiana.
I agree with that.
There are some, but.
So if we're talking about a retail account, what happens to cost basis when you reinvest dividends?
When you reinvest dividends, you're actually adding to that cost basis because you have to pay the tax on the dividend every year when it's earned, right? So if you've got a mutual fund, for instance, this has happened to a lot of people the last couple of years, where any distributions have automatically been reinvested, you still get a 1099 at the end of the year on that. Just like you would in a CD where you're going to pay taxes on the interest, but you let the interest actually grow with the CD, if you will.
Okay. Now, if let's say you have an asset that's really, really old, like decades old, how do you determine cost basis for?
It's a toughie, and I've seen engineers who want to be exact about everything that they do, try to go back and find brokerage statements from the 70s and the 60s. Bottom line is the best you can do is come up with what you believe is a reasonable value. And this is one area where we do use the internet. We will go in and pull up historic prices for something over a 10-year period of time, and knowing that that's where it came from, and put in a reasonable amount as opposed to an exact amount.
So can the IRS audit?
Sure they can,
cost base?
but the IRS has the same problem that we do in being able to do that. It's why every brokerage account that gets transferred these days has your stock basis with it. When we move your account over, your basis travels. One of the first things that our investment team does is to make sure that the correct basis is established, because a lot of times they're not. People will put in zeros that don't understand taxes, and we'll have assets. You got $1 million account, and suddenly your basis is $200,000. I don't think so. It can happen, but many times there's mistakes that are made that because of our size and and how we fit into the system, we can fix if there's a known error.
So does your financial advisory firm, if it's the Financial Enhancement Group or someone else, do they track cost basis for persons who are...
They better. You are technically obligated, but that is one of the services that they most of them provide. The big wirehouses, Merrill, Morgan Stanley, certainly all of us that are registered investment advisors have to do that. So the Financial Enhancement Group, like you said, the Oxfords, we're going to do that and need to.
So what happens if you make a mistake on reporting your cost basis to the IRS?
Then you've got to amend your tax return if you really made a mistake, either to your favor or to your detriment, right? I mean, that's the way it is.
Okay, now what about a company that no longer exists? I think what they used for an example in an article I found was AT&T. You had stock in it.
Yeah, but AT&T didn't disappear. There are companies that get renamed. There's companies that get reorganized. There's companies that go bankrupt. If you get a little bit of value out of them, then you still keep track of it. But your basis typically travels with the stocks that got spun off. Let's say we own $100 of Financial Enhancement Group, a stock for $100, and we put $50 into it as our basis, right? And we rolled off Financial. We kept Enhancement Group over here, but we rolled off Financial into another company. The IRS would help us, but we would determine that our basis may be $30 in the financial part with a $20 gain. It may be worth half of the EG, for instance. And so you usually know that, or you're told that ahead of time.
Now, how would you determine cost basis if you inherited stock?
If you inherit it, that means somebody died, right? Remember, there's a difference between a gift and inheritance. So if you inherited it when from somebody who passed away, your basis is the basis is whatever the fair market value of the asset is that day you inherited it. So if Ken inherits a tree farm and the tree farm was worth $7 million, his basis in the tree farm is now $7 million. Congratulations.
What about a house?
Same thing.
So
especially property that's depreciated. This is why people die with real estate.
So if somebody buys a residence or is inherited a residential house,
your kids inherit your house, it's going to be what the fair market value is of the house at the time. Right? And that's an inheritance. Remember, a gift is different. If you gave your house to your kids, their basis is your basis.
Gotcha.
What are some of the options if you simply can't even determine what the basis is?
Your CPA is going to help you come up with a fair and reasonable amount, and you've really got to do that. Now, I will tell you, there's one thing on this, and you can go ahead and ask it. I mean,
I knew you wanted to mention maybe long-term.
It's a weird part of the tax code that people forget. Barb and I file a married return, right? And married filing jointly is the status. And what happens is you have to pay taxes on all of your capital gains that you have every year. Your long-term capital gains that you recognized, you've got to pay taxes on. But what if you have a loss? Well, if you have a loss, you're actually allowed to deduct $3,000 of losses, even if you didn't have any gains. But everything above $3,000 that was lost, you're carrying over. It's called a carry forward loss. And one of the things that people forget about in estate planning is half of that carry forward loss is the spouse who's getting ready to die or who did just die. And I've seen CPAs, I've seen tax equipment, I've seen people make mistakes and not adjust that, but they should. It's half owned by the other party that is there. So you really want to pay attention to those carry forward losses and your long-term capital gains. We have systems and processes in place to harvest losses every year so that you don't have that. So we don't see a lot of our families with carry forward losses, but we had a new family that came in, I think, in December that had almost $400,000 of carry forward loss. Some of it's still left over from the tech wreck in 2000.
Oh, wow.
So you're listening to Consider This with Joe Clark, Ken Dilger, and Angie Kinzer. Happy New Year. I hope you're enjoying your time so far. And if you've got an issue with cost basis, we're more than happy to help you, to help answer it. But a lot of these are tough calls for people to make. Biggest thing to remember, if it's an inherited asset, you get the cost basis is equal to the fair market value today. If it's one, on the other hand, that was given to you or given to you in the past via trust, your basis is what their basis was when you received it.
Hi, Joni Michaels here. Joe's been hosting financial radio programs for over 20 years, and during his 7 years at Purdue, Joe developed the 5 critical elements. You see, there are 5 areas we all go through that can impact and even derail our retirement plans. YourLifeAfterWork.com has been focused on you on your retirement for over 20 years. You may have had a 401k as well as IRAs. Those are all defined contribution plans. Consider this program is about your defined contribution plans becoming defined distributions. You see, we all exit. You'll either take money out of those retirement plans when you decide or when the IRS decides, or your heirs will have to deal with the situation, but we all exit. I encourage you to call 800-928-4001 to meet with one of the talented financial advisors at the Financial Enhancement Group. I've listened to this show for years, and what Joe says just makes sense. Don't you think it's time for you to call 800-928-4001, YourLifeAfterWork.com. Now let's get back to the show.
So you're sitting around with friends and family discussing retirement tips for 2020. What would you come up with? What would you tell your neighbor? That's what we're going to do for you this morning right here on Consider This Program. I'm your host, Joe Clark.
I'm Ken Dilger.
And I'm Angie Kinzer.
And Angie's in charge of getting all of the questions and comments. She's also the one who's the nibby internet mom who finds these articles that are out there and goes, now that's interesting.
Well, I also look for questions. And I think, if other people are asking these questions, then our listeners may have the same questions.
All right. Well, give Ken his first tip. If he's going to retire this year, I'm sure his friends will appreciate that. But if he was going to retire this year, what tips would you give him?
Well, it kind of starts off more with, I'm going to start off with a question, and then we can follow it up with the tips. But the question is, I plan to retire this year. My nest egg, the markets, and the economy all appear to be in good shape. My question, am I missing something? Is there anything on the horizon financially that would make retiring in the near future more risky than not?
Well, what do you think, Ken?
Boy, that's a good question. I really don't know as far as the outlook of, the taxes and financial.
All right, fair enough. I guess that's why it's Consider This Program with Joe Clark. I get it. Fair enough. Here's the thing that I think it's most overlooked. And I just told somebody at lunch today, Angie, we will always go toward the answers that we want to believe to be true, right? You go to the doctor, and the doctor says you're going to be fine, everything's good. I bet you've never asked for a second opinion, right? Same doctor, same credentials, same building, now tells you, Angie, this could be really bad, and you've got a second, third, and fourth opinion lined up that afternoon, right? I mean, that's how we are. And so people, when it serves their purpose, will say, well, what if I die too soon, right? And they usually use that to justify getting Social Security earlier than they probably should. But then they'll turn around in an entirely new paragraph, but same discussion, and say, well, what if I live too long, right? And they really don't give that one much credit because they don't think about the real impact. But the real impact is inflation, right? It is the value of a $5,000 pension in 1 year versus a $5,000 pension 30 years from now. And that purchasing power as it gets whittled down is a big deal. So I think and Bill Gates said this in 1995 in a famous quotation, that the world overestimates what can happen in 24 months and clearly underestimates what can happen in 10 years. And he was obviously talking about technology, but I would tell you from a retirement standpoint, that's profound. And most people live a lot longer than 10 years in retirement now. You're dealing with 20, 25 years, 30 years if you have a spouse. That's probably the biggest one I would say people need to be cognizant of.
Should we plan ahead for a correction? I mean, is that something to think about if you're going to retire in 2020?
If you can help me plan ahead for a correction, 800-928-4001, I'd be happy to have you. Remember, economies and markets are never correlated, right? The market, if anything, is a leading indicator of where an economy is headed. But to look at an economy and try to predict a correction in the market is just
maybe not
dangerous.
Predict a correction, but ask yourself this question. Could you stomach, with the way your assets are invested today, a drop of 50%?
But it's only half of the question. And number one, you should never be in anything where 50% of your money can go away, right? You just shouldn't be. I realize that happened in 2008 to people who were doing it on their own, but I don't know many people in the professional world that were down more than 30%. It's because of diversification, because of being fiduciarily responsible. So no, I mean, okay, if you're going to ask yourself that question, then you have to have the other half of the question. And so, am I willing to lose this percentage of my assets if my money were in this type of portfolio, right? And what they're trying to get with that is, in theory, the more conservative you become, the more fixed income you have, where you're allegedly, and I keep saying these alleged words because the bond market has been anything but stable the last few years. But if you've lowered your assumption rate on growth, you tend to think that you're in a safer place. I'm just telling you that that's not always true.
Okay. Well, I know at the Financial Enhancement Group, we work in models. So this question is, if you're thinking about retiring in 2020, should we move our accounts into something less risky?
Well, so define risk for me.
Well, I guess
I guarantee you there are people who've been listening to this radio show for 20 years who just screamed it out in their car, right? Here's the definition of risk. It's when you get something different than what you expect, right? It's that simple, right? It's and people say that the stock market is risky. It is not risky by definition, right? If the stock market goes up 50%, Ken, do you call that risky?
No.
No. If it goes down 10%, you call that risky?
No.
Oh, well, that's good for you. Angie, on the other hand, is a tightwad. If it went down 10%, would you call that risky?
Yes.
Yes. Anything down is risky. Anything up is not risky. And both are wrong. The stock
Was it volatile then?
Stock market is speculative.
Speculative.
It was always speculative in all the history books that we read, right up until Roosevelt got in that chair next to the little radios, and it was called the fireside chats. And either he or his speechwriter, nobody knows, interjected the word for speculative into the word risk because they needed money back into the banks. And we still use that today, but risk by definition is when you get something different than what you expect. As long as you can live in that confine, it's okay. The problem is I've yet to see anybody who hears the word risk and can associate it with positive, right? Nobody says there's a risk I might get the job.
Right. That's a chance.
I mean, it's an opportunity, right?
Yes.
There's a risk I could have the flu, right? There's no way to put positive to this.
There's a chance you could get the job. There's a chance you couldn't get the job either.
But you didn't say risk.
True.
You said chance. Back to speculative.
What is emotional discipline? Because I noticed it talked about that quite a bit.
You have heard, because, well, you weren't here in 2008, but our mantra here at the Financial Enhancement Group is no heavy breathing, right? We know that headlines do not move markets, right, historically. We're going to talk about that in the Market Carver this week, and if you don't get our Market Carver, you can either call Angie at 800-928-4001 or go to our website at yourlifeafterwork.com and get signed up for it. But I talk about things, or Adam, our chief investment strategist, one of the two of us, will talk about things that tend to confuse people. And this week I'm going to break down the wars for you because people are worried over what's going on with Iraq and Iran and the issues that are over there. So the market in World War I, World War II, Korea, and Vietnam, what do you suppose the Dow Jones Industrial Average did, Ange? I've really set you up for this. In all four of those wars, the market was up, right? Another one that I'm going to talk about this week is on consumer sentiment, which is now lower. It's actually going down. There's not been a period. We've only had 8 of these experiences, by the way, where you've had economic data where it is and consumer sentiment declining. But in all 8, the market was higher 3 months later. It's a contrarian indicator. And so people think about headlines and they try to figure out what's going on by people who are paid lots of money to influence them. Right? It's like I look at my wife and my daughters and I say, do you understand this company called Facebook has people that they pay $1 billion a year to figure out how to get you to look another minute a day, right? And these people are paid a fortune to figure out how to get your eyeballs on that phone. The same is true in the media, right? When we write headlines, when we do those things, my job is to get you to read the article, right? If the headline's boring, the article probably isn't any better. Right? Hey, you're listening to Consider This Program. I'm Joe Clark, along with Ken Dilger, Angie Kinzer, trying to give you some retirement tips on 2020. If I had to tell you the one thing that concerned me the most for people, it's forgetting how long you can really live. Thinking more can happen in the next 2 years and less will happen in the next 10. Thank you to Bill Gates for that wonderful wisdom. That is what we need to be aware of. Give Angie a call, 800-928-4001. If you want to do this on your own, that's your business. If you're looking for a fiduciary, that's our business.
Hi, Joni Michaels here. We know you care about your money, but are you tired of worrying about it? The Financial Enhancement Group takes care of people just like you who don't want to worry about their money. As fiduciaries, the team at the Financial Enhancement Group will care for your nest egg just like they would care for their own. If they were in your situation, there are many decisions you'll need to make as you face retirement, and the team at the Financial Enhancement Group is here to help you. Call 800-928-4001 or go to yourlifeafterwork.com to set up a time to meet. The confusion and complexity of retirement is almost as daunting as is the excitement of retirement. Don't let your fear and frustration of taxes and investing derail your retirement. Call the Financial Enhancement Group at 800-928-4001. They'll give you a complimentary second opinion on your strategy for retirement. Begin your adventure in your life after work. Call 800-928-4001 or yourlifeafterwork.com. Now back to Consider This program with Joe Clark.
There is a lot of different strategies that go on in the investment world. Some say you want to focus on things that produce dividends, some on capital gains, some that say you just want to make as much money as you can. Then there's others that say I want to make money in particular areas. I can't give you the right answer for you, but we're going to break down a Wall Street Journal article that came out a few weeks ago that said, when God is your portfolio manager. Angie found the article, liked the article. She's got some questions for me and Ken. We're going to run through those for you today. I'm Joe Clark, your host of Consider This program.
I'm Ken Dilger.
And I'm Angie Kinzer.
And Angie has the mic, so she gets to ask the questions, and we will see where this goes. It was an interesting, I have a small group. I'm part of a church in Indianapolis called Northview, and it was interesting that we are in one of my favorite conversations. It's a series over habits, and we were talking about the will of God. And asking ourselves if when we're making the decisions that we're making, are we truly in God's will? So when Angie said she wanted to talk about this portfolio thing, I'm going, okay, kind of goes along with last night's conversation. Have at it. I'm ready.
Okay. Well, this article does talk about faith-based funds, but, first of all, can you invest directly in a church?
No. You cannot invest directly in a 501c3. You can invest in the church's work, right? Mm-hmm. You can invest in missions. You can invest in stuff that you and I used to do at the bridge, but when the bridge was still here in town. Mm-hmm. Lord knows we spent money doing that. But you cannot invest in a not-for-profit, because investing means you're trying to earn profit. You can work for a not-for-profit. Don't confuse the two, right? So people will see hospitals build new buildings, and they'll go, well, I thought they were not-for-profit. It doesn't mean that they don't pay their people well, right? Right. It's one of the things that we look for in that world. So no, you cannot invest in technically a not-for-profit entity. Okay,
then what exactly is faith-based investing, and what does it mean?
Very abstract. And we had this example, and I think I talked about it when we talked about environmental, socially responsible investing a few weeks ago. And it's the faith-based tends to have this notion that we're going to invest in companies that match our faith, right? So I'll give you a perfect for instance. Find me a healthcare company that does not have something to do with abortion or something to do with fetus that is not part of the Catholic Church's area of going. Christian Scientists, we manage money for one of those churches. And we just simply don't have any health care, right? That would be their faith. They don't care in one of those situations if we have tobacco, firearms, and alcohol, right? Most of the funds that say that they are faith-based, and no, this is not anything we do nor support. We don't own mutual funds. I need to say that very, very clearly. We believe far more in exchange-traded funds, and we want to have investment strategies, not try to tell companies to stay out of this business or stay out of that. Now, I have never in 30-some years of being in this industry gone out and intentionally bought a tobacco stock. It's just not my thing. But, they're out there, right?
How do you know what a company supports? Do you have to do your own research?
Most company, if you're talking about an individual company, most individual company will tell you their social policy. You do not have to look hard. I've put mine in print. Barb and I's mission statement, very, very simply, is to take care of homeless, hungry people and dogs, not cats. Right. So it's, the ministries that we give money to, it's very easy to see how we feel about our individual money. Right. If you went to the Financial Enhancement Group and looked on our site, you can see the stuff that we provide to animals and homeless, hungry people. We support the Christian Center, here in Anderson, where our headquarters is. So it's very easy to get that cultural stuff. The problem is when you're investing, right? And we judge our own issues, our own habits, hobbies, whatever you want to call them. We judge them different than yours, right? I am not a fan of cigarette smoke. I watched my dad virtually kill himself on that. But I've been fat most of my life, right? I don't tend to judge fat people as hard as my skinny friends judged me, right? We're more comfortable with our own vice than we are others. There are people I used to have wine. I like wine, and I've got friends that would promptly head themselves to the casino to put money in the one-armed bandits, as I like to call them, but thought that I was bad because I was having wine. And what do you mean you go to church? Well, and we get into these crazy discussions. It was just amazing, different people's viewpoints.
I remember our pastor saying Jesus didn't turn that water
into
Kool-Aid.
Grape juice. It was not. That's right. That was what Mishler would say. It was not Kool-Aid.
It was not Kool-Aid. So I wonder if some consumers can be taken advantage of by companies who claim to be faith-based.
No different than pastors on Sunday morning on TVs. They're not all good, and they're probably not all bad. Actually, I know some of them aren't bad. So I would say the answer is you always can fall prey to a sly, sneaky sales type driven thing, and don't think that all of the companies that do faith based are there because they're in the faith based spirit. I've got friends that focus all of their financial planning on women, and that's because we know that 70% of the time the woman winds up with the money, right? And so they said, why would I ever focus on Ken when I can focus on Angie? And it's not that they love women more. This is a marketing decision, right? I get it. It's just I refuse to play that game. We've never done that at the Financial Enhancement Group. And we're not gone as long as I'm the one that's in charge of it.
Now, when folks come to the Financial Enhancement Group, what if they have certain stocks that they want to keep? And we have our own processes and ways that we...
If it's in an IRA, it's not an issue because there's no taxes, and it doesn't take people long to realize in our process that they just need to go. When it's stuff in a retail account, if you refer back to our first conversation this week, where we talked about people having long-term capital gains or those kind of issues, then those issues are dealt with on a more individual basis. If it's a company and we've got people on bank boards that have to have bank stock, we typically have that stock outside of one of our managed accounts so that it's not an issue and it's easier for them to track it. But there are situations where we have to make amends for that and work around it.
And that's a little bit different than being emotionally attached to a stock.
We used to have people who were much more emotionally attached. I would have people that own General Motors stock, and they would look at me when GM got above $100 a share and say, you could never sell that stuff. And I'm going, they just gave me a Suburban for I think $300 a month left on a lease for a 2-year newer vehicle that was already 20,000 over its mileage thing. And the salesman made it very, very clear, the owner of the place actually made it very, very clear that they didn't know how to account for it in accounting, the mileage over. And I said, this stuff's got to go, right? I mean, GM's leasing more cars almost than they were selling at the time. It's got to go. Oh, no. Then when it got to 50, well, as soon as it gets back to 100, it's gone, right? The emotional attachment to most companies has left the building. Lilly, Caterpillar, GM,
Your Harley Davidson?
Well, yes, my Harley Davidson stock. I miss the bike more than the stock, just saying. But no, don't have the bike anymore either.
Okay, well, basically, the last question is kind of an opinion thing because all throughout the article it says...
I'm kind of good at opinions.
Yeah, I know. Do you think faith-based investing is on the rise or...
Ooh, I would say not, because the mutual fund environment is very much declining precipitously. The exchange-traded fund environment, which are more passive index, is rising. I can't say that with all certainty. I think people are finding that that's probably not the best thing when you look at the math month over month, year over year. Hey, you're listening to Consider This Program. I am your host, Joe Clark, along with Angie Kinzer, Ken Dilger. You got a comment or question, give us a call at 800-928-4001.
Hi, Joni Michaels here. Joe's been hosting financial radio programs for over 20 years, and during his 7 years at Purdue, Joe developed the 5 critical elements. You see, there are 5 areas we all go through that can impact and even derail our retirement plans. YourLifeAfterWork.com has been focused on you, on your retirement for over 20 years. You may have had a 401k as well as IRAs. Those are all defined contribution plans. Consider this program is about your defined contribution plans becoming defined distributions. You see, we all exit. You'll either take money out of those retirement plans when you decide or when the IRS decides, or your heirs will have to deal with the situation, but we all exit. I encourage you to call 800-928-4001 to meet with one of the talented financial advisors at the Financial Enhancement Group. I've listened to this show for years, and what Joe says just makes sense. Don't you think it's time for you to call 800-928-4001, YourLifeAfterWork.com. Now let's get back to the show.
Sometimes the best laid plans of mice and men can go awry. And Roth conversions, that's no exception. One of the most beautiful things in the tax code, one of the easiest things to say, this is beautiful, can also be one of the most difficult things to pull off. Join us this week on Consider This program as we begin to break down just what it means to take money from an IRA and convert it to a Roth. I'm your host of Consider This program, Joe Clark.
I'm Ken Dilger.
And I'm Angie Kinzer.
Happy to have you both along, as well as you folks that are listening out there. All right, Angie, fire away.
Is it better to convert funds to a Roth before or after you retire?
Somebody who recently came in, who's listened to all of the radio shows, all of our podcasts back, I think, to 2017 when we had to update the stuff with Apple, said, if I hear Joe say one more time that Google is data dependent, not date dependent, I'm going to scream. Well, I'm sorry. Google is data dependent. That means in 2007, when they essentially took away the AGI restriction for Roth conversions effective January 1st of 2010, I wrote no less than 100 articles over a 10-year period of time telling people that you want to convert a Roth IRA as soon as you possibly can in the year, because you're looking for all of that tax-free growth, right? Suddenly, December 22nd of 2017, they changed the tax code. And Ken, in one fell swoop, we lost the ability to do Roth conversions with a recharacterization provision, meaning we could change our mind later on. What that means is if I decide to convert money in January of 2020 of $50,000, and I do it on my assumed tax rate of what I normally have, but all of a sudden something happens at the end of the year and I get a big bonus or something happens, and all of a sudden my tax bracket is greatly increased, I'm going to pay taxes on that Roth conversion at a much higher tax rate than I intended to. Now, you're almost historically always better to invest the sooner you can in a market, right? I mean, let's think about it. We're at a market high for all intents and purposes. If you could go back and invest the day before the market crashed in 08, which was really October 9th of 07, but if you could go back and invest the day before that, you'd go, what would an idiot be like that? They would have been down 50% at one time, Angie, but they'd also be up a lot more than 50% now, 10 years later. You're almost always better to invest sooner than later over the long term. But taxation is a big part of a Roth conversion. And when you convert money out of an IRA, you're agreeing to pay taxes on that money today so that you don't have to pay the taxes in the future. And what I wrote in literally 100 articles, I think it was 103 when I counted them, is contrary to what it needs to be today.
Is there an age requirement for converting retirement funds to a Roth?
There's not you have to have retirement funds, right?
Yes.
Because you can never convert an inherited IRA. So let's say that Angie inherited money and it was an inherited IRA. It has to stay in the status that it came in. It's either converted already or it ain't ever going to be converted. Okay. So I would have to be 16 and already have been wise enough to put money into an IRA. My tax bracket would have had to have been high enough that I would have wanted to be deferred, which would kind of been stupid, right? So the correct answer to this program is it's probably immaterial. An interesting question, but not a likelihood.
Well, the next question you kind of covered in the first one, which is why is it important to know your tax bracket before converting?
Well, because you're going to pay that taxes now. And, the Ken used the word volatility, and, when they talk about the stock market, and it is volatile.
Mhm.
So is your tax rate.
Right.
Your tax rate is volatile over forces that you can control to a degree. The amount of income you make, the amount of assets that you sell in a given year, the amount of money you pull out of an IRA or a 401k. But it's also subject to forces you cannot control. You getting laid off, you getting a huge bonus at the end of the year, and you can't control how the IRS changes their tax code. You have to look at your taxes this year as if they're on sale. We know December 31st of 2025, we revert back to the tax brackets from 2017. And once that's done, ladies and gentlemen, your tax rate is going to go up. It's usually about 3% on 3 points, we will call it. It's about 12% increase for most of us, across the board, for some even higher.
Well, and since we know that we have to pay taxes right now on a conversion, let's say you're under 59 and a half and you do a conversion, can you go ahead and take out some extra to pay the taxes?
I have never in my entire time of doing this ever seen where it made sense to use part of the money that I'm going to do the conversion on to pay the taxes on that. I mean, one of my rule was if a Roth conversion made sense, you had to have the cash to pay the taxes outside of the conversion. And today, we converted somewhere between $15 and $20 million worth of conversions between 2007, not counting backdoors. I mean, these are big conversions for more than 100 families, and it's now worth more than $50 million. They're never going to pay taxes on that money. It's a beautiful, beautiful thing, right? But I never would tell somebody to take money out of an IRA, convert it, and use part of the money that they pulled out to pay the taxes. It just doesn't make sense. So can you do that under 59 and a half without a penalty? Absolutely not. Nor should you, in my opinion, if you're over 59 and a half. And there may be an extreme situation, but I've not seen it.
Okay. How does the pro rata rule impact conversions?
This is where people get into trouble. The IRS aggregates all of your IRAs. Notice I didn't say all of mine and Barb's. So it stands for Individual Retirement Arrangement. That's what an IRA stands for. So Joe has individual retirement arrangements. I don't, but let's say I had an IRA that was tax deferred, and I had money that was in a Roth. And let's just say they were half and half. So $50,000 was in an IRA and $50,000 was in a Roth. And I wanted to convert money out of my IRA to add more to the Roth, right? The IRS is going to add all of those together. So there's $100,000 of IRAs. And if I was doing a $10,000 conversion, the IRS would say a certain percentage of it was taxable to me because it was out of the tax-deferred IRA, and the other percentage would go to the converted amount, would go to the Roth amount, and would be a tax-free transfer, right? But you're always going to get hit with that IRA stuff. This is one of those things I would never tell you if you've got an existing IRA. We always run it through one of our CPAs that are here in-house. Brett Spangler, or our friends at E-Step Doctor and Company, or Mike down in Indianapolis. We've got a series, and Huth Thompson, obviously, in Lafayette. We have a group of CPAs that we work with to make sure that math is done correctly, because that the pro rata rule is serious, and like I said, you cannot recharacterize anymore. So if you mess that up, you've really messed it up.
What exactly is a non-deductible IRA?
Non-deductible IRA is anybody who now, with the Secure American Act, we'll talk about next week, if you have earned income, you no longer used to have to be under 70 and a half. Now, if you're over 70 and a half, but you're still working, you have the ability to contribute, if you have earned income, into an IRA. And now, whether that IRA is deductible is based on your income, your spouse's income, and your access to a retirement plan at work. So I put money into a non-deductible IRA every year. I have a 401k at work, and my income's at a point where I'm not allowed to get it tax deducted, but I go give Renee a check every year, and we do what's called that backdoor conversion, where we immediately convert it into a Roth purely by the tax code. And so even though I'm not eligible to contribute to a Roth IRA, I am able to use that technology to contribute to, or that tax code to contribute to, a non-deductible IRA that becomes a Roth. It's a beautiful, beautiful thing, but it's also where the pro rata rule comes into play. Please, please be very careful. All right. Hey, you're listening to Consider This Program. I'm Joe Clark, along with Ken Dilger and Angie Kinzer. Give her a call, 800-928-4001. If you want to do this on your own, that's your business. If you're looking for a fiduciary, that is our business. 800-928-4001.
Hi, Joni Michaels here. We know you care about your money, but are you tired of worrying about it? The Financial Enhancement Group takes care of people just like you who don't want to worry about their money. As fiduciaries, the team at the Financial Enhancement Group will care for your nest egg just like they would care for their own if they were in your situation. There are many decisions you'll need to make as you face retirement, and the team at the Financial Enhancement Group is here to help you. Call 800-928-4001 or go to yourlifeafterwork.com to set up a time to meet. The confusion and complexity of retirement is almost as daunting as is the excitement of retirement. Don't let your fear and frustration of taxes and investing derail your retirement. Call the Financial Enhancement Group at 800-928-4001. They'll give you a complimentary second opinion on your strategy for retirement. Begin your adventure in your life after work. Call 800-928-4001 or yourlifeafterwork.com. Now back to Consider This Program with Joe Clark.
Well, good morning and welcome back to Consider This Program. I'm your host, Joe Clark.
I'm Ken Dilger.
And I'm Angie Kinzer.
So the program is brought to you by the Financial Enhancement Group. In case you're missing it, we are registered investment advisors. As of January 1st of this year, we're right at that near $500 million mark. It's really exciting, $496 million. By the time you hear this, that will change because the market changes. But that's where we were at this point in time. Very, very honored to do that. We serve as fiduciaries. The Financial Enhancement Group sponsors this program. I've been on the radio for a little over 20 years, bringing this to central Indiana and now to 30-some states across the country. So we enjoy it. Angie is responsible for getting all of your questions and comments and kind of directing the show. And Ken's here to make sure that I talk about IRAs and taxes at every given opportunity because that's not his favorite part of the financial world. But, you know, we can't talk about mortgages every week. We did get a great question.
Yes.
And I want to go ahead and answer that because if somebody's going to take the time to listen to the show, and especially in the podcast, take notes, and then didn't get everything that I tried to provide, I want to make sure that I do that. So I talked about reverse mortgages probably a month ago. I was when reverse mortgages first came out, and this is how easily you can get blindsided. When reverse mortgages first came out, they were sold by people that I regarded as flim-flam men and women. They were obnoxious-looking beasts that I couldn't imagine anybody in their right mind ever buying, and kind of put a spot up against them and just said, "There's just no way." And suddenly, one of my professors who taught me when I was getting my CFP back at the College for Financial Planning started writing books about these and about how important reverse mortgages were. One of our families addressed the issue with me, a very, very smart lady, and said, "Hey, Joe, you need to relook at these. I intend to use one." And I did, and boy, she was right, and I thank you for that very, very much. And so we did a segment on reverse mortgages. There's things to watch out for. There's things to understand. But his question was, when would it be right? So here's the deal. Markets are volatile. Ken, would you agree with that?
Yes.
So there's some times when they're below where they ought to be, and there's some times where they're above where they ought to be. Now, for anybody to be able to identify that period of time is like the earlier segment where you said, if how do I plan for a correction? Well, diversification and tell me how to do that, and we'll all be together. What a reverse mortgage allows people to do is to take money out of their home. If they're over 62 years old, they can take money out of their home and use it to pay bills, to make investments, do whatever it is. So if I think about the two greatest risks in distribution, or what we call decumulation, they are your tax rate that you're going to pay on the money that you have to recognize that year, Ken. And then the second is volatility, right? So let's say I'm in a period of time like September to December of 2018, where the market just started going down and was really ugly. Remember, it was the worst December since 1931. Now, if your portfolio is set up correctly, taking your income distribution for that quarter shouldn't have been a problem. But if I'd already had a reverse mortgage set up and I saw the market beginning to decline rather rapidly, especially in December, I could have taken money out of my reverse mortgage, right? Now, I'm not 62, so I'm not eligible, but if I'd had a reverse mortgage, I could have taken income from there and and not taken money out when the market was lower. As the market had its great rise in 2019, I should have taken money out of the market at some point in time and paid down that loan. Now, let me do a couple different things. One, it got me out of some of the volatility. And the second thing that it did was allowed me to control my tax rate. So let's say I've got my reverse mortgage, and Barb gets the opportunity, my wife, the opportunity to go on a dream trip, right? And she says, honey, I need another $15,000 that wasn't in the budget. Well, $15,000 could take us from the 12% tax bracket to the 22% tax bracket overnight, right? That is not exciting to me to pay the IRS almost double. Now I can go to the reverse mortgage. I could take money off the line of credit of the house, not pay taxes on that money, give her the money for the trip. I win with the bank. I win with the IRS. I win with my wife. Life is good, right? You turn around the next year and you figure out over the next year or two how to pay down that money that you needed immediately while you do it inside of the lower tax bracket. So great question. Really appreciate it. Part of my point of answering this is I do want you to get the whole facts. Right? We take care of people who don't want to worry about their money here at the Financial Enhancement Group. We do that by reducing financial regrets. Right? I don't want you to make a decision and go, oh, I could have had a V8, right? Or if I'd only known where to go. Or I'm reading bad stuff on an article in Google that's only half written without all of the answers. So if there's something I ever talk about on this show, you've got a question or you need more input into it or more feedback, just give us a call, 800-928-4001. Or call Angie, and she can help get you set up with one of our advisory team. Happy to answer the question where we can. You had two more questions on Roth conversions you wanted me to hit.
Okay. Can you convert an RMD into a Roth?
No.
Well, that's not very nice.
Do you like the answer? There for a second opinion?
There are some things that are black and white, and there are some things that are not. And we're going to break down the Secure America Act next week on the show. So you'll be hearing and seeing a lot about it. But you can there's things that you can do to make contributions. RMDs have now been delayed if you are a person who if you're a person who happened to be under 70 and a half, or already taking RMDs, I should say, in 2019 versus somebody who just started the next day. It's I haven't seen the math, but apparently David Stern's dying on January 1st. Was that when he passed away? Was it January 1st?
I can't remember the exact date. It was right around there.
Well, the difference between the 1st and the 31st is probably six figures, and what's got to be paid out to the IRS. Just because of some of the rules that came out of the Secure America Act. And it's, we had a billionaire die the last year estate taxes were free, way back when, and then the next year, and he mysteriously died, late into December. And I can't tell you I wouldn't have been with him. So, but the answer is no, you cannot convert an RMD. You have to, now that once you've taken the RMD and paid taxes on it, now you've got money, and if you're eligible to contribute to a plan, you could use that to contribute. Okay. Even to an IRA or Roth IRA if you're eligible, but you still have to recognize the taxes on the RMD.
The other question is, what is a backdoor contribution?
That is a beautiful thing where we actually discussed it a little bit in the last segment. It's where you take money that is in an IRA that you've contributed to a non-deductible IRA and simultaneously convert it into a Roth IRA. So it's a conversion, not a contribution, perfectly legal and expressly made so in the tax code of December 22nd in 2017. So it's almost an immediate transfer. You contribute to a non-deductible IRA, you convert to a Roth IRA. Your only danger there that you have to pay attention to is making sure that you don't have other existing IRA money in that pro rata rule that we also discussed in the last segment. If you missed that last segment, don't forget you can go to our podcast, consider this program. You do have to put in the word program. It is the easiest way to get the show for many people, and you can always go back and get what you missed. Give Angie a call, 800-928-4001. Look forward to meeting you. Have an outstanding weekend, and we will see you again next time right here on Consider This Program.
Hi, Joni Michaels here. Joe's been hosting financial radio programs for over 20 years, and during his 7 years at Purdue, Joe developed the 5 critical elements. You see, there are 5 areas we all go through that can impact and even derail our retirement plans. YourLifeAfterWork.com has been focused on you on your retirement for over 20 years. You may have had a 401k as well as IRAs. Those are all defined contribution plans. Consider this program is about your defined contribution plans becoming defined distributions. You see, we all exit. You'll either take money out of those retirement plans when you decide or when the IRS decides, or your heirs will have to deal with the situation, but we all exit. I encourage you to call 800-928-4001 to meet with one of the talented financial advisors at the Financial Enhancement Group. I've listened to this show for years, and what Joe says just makes sense. Don't you think it's time for you to call 800-928-4001, YourLifeAfterWork.com. Now let's get back to the show.
Well, good morning and welcome back to Consider This Program. I'm your host, Joe Clark.
I'm Ken Dilger.
And I'm Angie Kinzer.
How was Christmas, Ange?
It was good.
How was New Year's?
Decent.
Do you have a relationship with the Amazon driver?
No.
Okay. I'm trying,
I wish I did so that I could get my things even quicker. Call in a favor.
I have accused my wife of having a relationship with this Amazon guy. And he's got a lot of sidekicks because there were 3 different drivers one day as we prepared for Christmas. So it's
well, then we need to accuse Heather as well, who sits at our front desk, because all of us here on the team, if we didn't want people at home getting our gifts or we didn't want packages sitting on our porch alone, we had everything shipped here. So she was sorting our stuff.
Then.
Oh yeah.
If they came wrapped, we would look like we were, like one of those Home Alone 3 Christmas trees. I don't know how anybody wraps all those packages and presents. What was your favorite thing you got for Christmas, Miss Kinzer?
Well, I have a new grandbaby.
Oh, that's right.
So I got my very first baby, Sawyer is her name, ornament that has her handprints and footprints on it.
Very cool.
So that was my favorite.
I don't do a whole lot of Christmas. Probably golf balls. I tend to lose a bunch of them throughout the year, so golf balls is always good.
It's that's because you need a club, not a stick, right? Yeah, it's a good plan. I think ours, as I thought about it, it came after Christmas. But watching my son-in-law's face, getting to watch his first NFL game, and actually getting down in the field at the Cowboys Stadium was pretty cool for him, and being able to watch it. And it's, we always do something real fun. The kids are young, and we were all young one day. Ken, you're still kind of young, but we made money, but you spent all the money, right? There wasn't a lot left. And one of the things that you can remember in the gifting rules, if you're so inclined and you're financially capable, is I gift money every year to the girls' Roths. And we use it as a matching program. So if they put money in over the course of the year, I put that additional amount of money in, obviously up to the government limits. But that is, I think it's a worthwhile way to get people started. Folks, your heirs are going to inherit money at some point in time in life. I would rather them learn how to deal with money while they still can, as opposed to get a surprise later on when you're gone. 800-928-4001. Give Angie a call, folks. Have an outstanding weekend, and please remember, if you are looking for a fiduciary, that is our business, and we'd be happy to meet with you. Have a great week.
You've been listening to Consider This Program with Joe Clark. As a certified financial planner, former professor at Purdue University, and with 31 years of experience helping families just like you eliminate the fear and confusion of retirement, Joe's team has the answers to your questions. Go to YourLifeAfterWork.com or call 800-928-4001 and find a time to meet with the Financial Enhancement Group. There's nothing that will separate you from your retirement as fast as the IRS. There are many questions that can be answered at the Financial Enhancement Group. Questions like when to take Social Security, how will my 401k be taxed? These questions are just the tip of the iceberg, and you need to be asking these questions now before it's too late. The Financial Enhancement Group has offices in Anderson, Fishers, and Lafayette, Indiana, but they also take care of families in 30 other states. You care about your retirement, you don't want to worry about your money? Then the Financial Enhancement Group is right for you. As fiduciaries, they are required by law to treat your money as if it were their own and they were in the same situation. Call 800